QuickBooks Pro Plus Desktop 2022 OneNote presentation, credit memo, refund form, and bad debt expense. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, the Topic Introduction tab, 1420, Credit Memo, Refund Form, and Bad Debt Expense tab. Also note, when using OneNote, take a look at the Immersive Reader tool, Topic Introductions, also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Also note, the name and number will also be in the presentations. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, and background accounting information that can complement and supplement the information we're going to go into within QuickBooks. If you would like to use the screenshots here to follow along with the presentations, if you don't have access to or do not want to have QuickBooks open, you can use it for that resource as well. Closing the icon on the left-hand side, we're looking at the credit memo. First screenshot is the home page of the QuickBooks. We're focusing in here on the customer section. We've looked at the customer cycle. We're focusing now on the refund and credit icon down below. Notice it's not part of the normal flow because hopefully we don't have to issue the refund or credit. We can zoom in on it a bit more in depth down here. Now this one is a little bit confusing in terms of the accounting. We will go through the accounting in Excel down below because it's kind of unnatural. It's something that's backwards. It's something that's reversing what we did in the past. And that means that our normal account settings going up when they normally go up are kind of reversed. So therefore, when you think about a credit memo, you basically want to think about the first transaction that was used to create the journal entry or the sale, the invoice, or possibly a sales receipt, and then think of the credit memo as, in essence, reversing the accounts that are impacted with the invoice. So in other words, you could have an invoice, for example, that was sent out. If it was for a service item, that would be a more simplified invoice, increase in accounts receivable, and the other side simply going to sales. If it was still in accounts receivable and we had not yet received it, and there was a problem and we had to basically reverse the transaction, instead of deleting the invoice, which we don't typically want to do because that would erase the audit trail, we want to issue the credit memo. And in that case, the credit memo would in essence simply reverse the accounts receivable and it would reverse the sales, which is kind of problematic because that would be a decrease to the sales account, unnatural, but a fairly straightforward type of transaction that would be applied there, and that would be in the instance that we have not yet gotten paid. A step up in complexity could be that we entered the invoice and we had inventory related to it, had not yet received the payment, and then they returned the inventory. In that instance, if we were to issue the credit memo, we can imagine what it would do. We think first about the invoice and then the reversing of it. Well, the invoice increased accounts receivable, that would go down. The other side went to sales. The sales would have to be reversed, which is again the tricky component because we might want to not decrease sales, but rather put it to sales returns and allowances or bad debt. And then the other side would be sales tax would be impacted as well that we would have to reverse, which could cause us problems. We have to make sure we do that so we pay our sales tax properly and don't overpay it. And then the inventory would have to be reversed if we got the inventory back and we're going to increase the inventory for it. And then the cost of goods sold would have to be reversed. So that would be a bit more complex of a transaction to reverse. Then we could also think about a situation where we received the payment already, and then the customer came back and they wanted a refund, possibly having an invoice that we had received the payment on or had a sales receipt, which then the customer came back in and said they wanted to return the item or that the service wasn't up to par and therefore we have to give a refund. In that case, same transaction, except instead of reversing the accounts receivable, which we can't do because we already got paid, we have to give them either money back or some substitute for money such as store credit or something like that. So those are all the scenarios, or most of them, that we could use this kind of credit memo for. So this would be the invoice. This would be an item like the starting point of the credit memo. And then oftentimes there's a situation with regards to finding the invoice within the QuickBooks software. In other words, if someone comes back and you have to issue a credit memo, you could start off just clicking this button, then typing in the customer, and then seeing if you can go from there to populate the credit memo. Or you might go to the customer itself in the customer center, find the invoice that they're talking about, use the invoice to create a refund or credit memo, the invoice then helping you to populate the credit memo. So in that case, you might go to something like the customer center. This customer, for example, comes in, says, hey, I need a refund. I'm returning the merchandise or the service wasn't up to par. And we say, okay, we'll issue you a credit memo. We might then go into the invoice and from there, then use that invoice to then create the refund or the credit memo, which will be easy from a data input standpoint, relatively speaking, to basically populate and process the credit memo. Credit memo looking like this, a lot like an invoice because it's hitting, in essence, the same accounts, but in essence, reversing those accounts. Really good practice to think about what the credit memo is doing from a journal entry standpoint. And the way to do that best is to first think about the invoice and then basically reverse what happened to it with the credit memo, making a tweak along the way that you might need, which is normally, instead of reducing the sales account, recording the other side either to bad debt expense instead or returns and allowances. So to do this within the QuickBooks system, to basically reverse this properly, we may need to set up another item, which might be something for an item that we can set up for bad debt expense. So I'm going to do a test one here just in QuickBooks, setting up a new inventory item for a new customer, test customer, inventory item set up for the inventory up top, putting this on the books for the $10,000. If we recorded this invoice, it would charge the customer $10,775, increasing the accounts receivable, sales going up by $10,000, sales tax payable, liability going up by the sales tax $775, inventory going down by the $8,000, and the cost of goods sold going up by the $8,000. So this would be the impact on the balance sheet and the accounts receivable. There's the $10,775. If we look at the sales tax, we could see the sales tax impacted. And if we look at the inventory, here's the inventory going down by the $8,000 from that invoice. If we issue a credit memo, and I just did the credit memo exactly, then it would reverse that exactly, meaning it would decrease the accounts receivable because we're assuming we had not yet got paid by the $10,775. It would decrease then the sales by the $10,000, that being the problematic point, because if I got inventory back, I might want to record it as bad debt expense or sales returns and allowances instead of decreasing the sales. That's where the tricky component is. It would decrease then the sales tax payable. It would increase the inventory if the inventory came back. That's also another tricky point, because do we want to increase the inventory? Is it something that we can add back to the inventory or not? Did we get the inventory back or not? And then we also have to say that the cost of goods sold would be reversed. Now, if I was to process this, it's going to give us this option, which is to retain as available credit, give a refund, or apply to an invoice. If we had not yet got paid on the accounts receivable, we would apply it to the invoice, which would reverse decrease in the accounts receivable. If, on the other hand, we're given the credit and it's not tied to accounts receivable, most likely because they paid us already, we'd have to give them a refund, in which case it would generate a check or some kind of payment form, or we can try to give them store credit as a component. So if we record that, then on the income statement, it would in essence reverse the entire thing, and we would have reversed basically the invoice on the income statement, and you could see the invoice going in, coming back out on the income line item. This is the tricky component, because really the income line item, we might not want it to reverse income, because income usually only goes up. We might rather want to put a contra income account like sales returns and allowances, or possibly the expense account of bad debt expense. So here's going to be the construction income. So now the next thing we could do is say, hey, I don't want it to reverse the income. So what I'm going to do is set up a new item called bad debt expense and take that to the bad debt expense. And then I'll adjust this credit memo, making that first item 0, but still keeping it on the books, because we're assuming that we want to be receiving or have the adjustment to the inventory. So although it's 0 at this point in time, that therefore not going to be reversing the sales item, it's still going to do what it needs to do to the inventory, increasing the inventory and reversing the cost of goods sold. The bad debt then is doing the rest of the job here for the 10,000, recording it then to bad debt expense where we want it to go instead of reversing the sales account. So this is a little bit tricky. We'll do this in QuickBooks. You can watch the presentation for more detail on that. But if we enter this and then we see the income statement, we got the 10,000 construction income, and then we've recorded it as bad debt expense instead of negating or reversing out the income line item. You can also see it reverse out on the customer balance detail report. So that's going to be the general idea. Let's think about it in terms of debits and credits from an accounting standpoint. So if I had the original invoice that we're later going to issue a credit memo for, here's the invoice. Here's going to be an example of a credit memo. The original invoice, let's think about one that first doesn't have inventory related to it. We'll think more about the inventory situation in a future presentation. So we're going to say the accounts receivable goes up by the 1,600. Sales goes up by 1,600 for the original invoice. So the accounts receivable was at 2,000, goes up by 1,600 to 3,600. Sales goes up, was at 200,000. It goes up by the 1,600 to the 201,600. The impact on the income statement when we issue the invoice, 24,710, that being the sales minus the expenses, starting point, credits, not a loss, but brackets being credits, goes up by 1,600 to the 26,310 when we issue the invoice. The impact on the general ledger, 2,000 in accounts receivable goes up by the 1,600 to 3,006. 200,000 in sales goes up by the 1,006 to the 201,600. Then we have the accounts receivable sub ledger. We're going to assume customer 4 was the one we issued the invoice to, bringing their balance up to 1,600. The sum of the 4 customers adding up to the 3,006, tying out to the general ledger, 3,006. Then we're going to assume we issue a credit memo for it. So we're going to have the standard, the easiest kind of credit memo, assuming we issued something. This would be an example of the credit memo, assuming we issued it for a service item, the invoice, and now we're reversing it, and we had not yet received the receivable. So we're just going to reverse the receivable, and we're going to reverse the sales exactly. This component, this top half, is the tricky part, because if we hadn't received the receivable, we might want to say in the future, I want to write it off, say to bad debt, for example, if I couldn't get collection on it, or if it was inventory, possibly reversing it to sales, returns, and allowances. So let's first think about if we issued the credit memo and just reversed the transaction exactly, then I would say, okay, well, we credited sales, we're reversing it now, we're going to debit the sales, and we debited the accounts receivable with the invoice. So with the credit memo, we're going to credit the accounts receivable. The impact net of those two transactions is to zero everything out, being back to where we started from at the first point. Sales went from 200,000 up by the 1,006 to the 201,600, then back down by the 1,006 with the credit memo to the 200,000. This decrease in sales, unnatural, unusual. Sales never goes down for the most part unless there's something unusual happening and or they're closing it out at the end of the month or year to the equity section. So that is what we're going to change next time. So here we have the accounts receivable going up by the 1,006 to the 3,006, back down by the 1,006 to the 2,000 after the credit memo. The accounts receivable subledger down here, customer 4, we sold them the goods or the services, and then they wanted to not pay us for whatever reason, so we negated it back down to 0. That adds up for the 4 customers, taking us to the 2,000, matching up to the general ledger and the subledger. So let's think about the next scenario. This time, we're going to start at the same starting point. We're going to issue the invoice, service invoice, still same starting point, but when we have the credit memo, we're going to adjust the reverse to the sales to bad debt expense instead. So now we're going to say we have an invoice increases 2,000, sale that we made, sales go up by 2,000. So we got the accounts receivable started at 2,000, up by 2,000 to 4,000. Sales go up from 200,000 by 2,000 to the 202,000. We've got that net income went up by that 2,000 from the 24,710 up by 2,000 to the 26,710. Accounts receivable subledger started at 2,000, went up by the 1,006 to the 3,006 for the prior invoice. Then the credit memo back down by the 1,006 to the 2,000. Now it's going from that 2,000 back up, this time by 2,000 for the new invoice to 4,000. The sales were at the 200,000. They went up by the 1,006 to the 2,016. Then we issued the credit memo taking it to the sales, which is weird, decreasing it back down to the 200,000. Then we increased it back up by the 2,000 for the new invoice to the 202,000. The subledger, now customer 1, we're assuming, increased by the 2,000, had a balance before of 1,000, bringing us to the 3,000. The 4 customers adding up to the 4,000, tying out to the general ledger. Okay, so then we're going to issue the credit memo. The credit memo goes out, but we're going to adjust the credit memo. And in QuickBooks, we would have to use something fancy like this changing the item, which you're going to have to look at QuickBooks presentation to get more detail on how to do that. But in journal entry format, we can easily think about what we want to happen. We're going to say, all right, well, now I want to reverse this, reverse in the accounts receivable because they're not going to pay us. And you could assume in this situation, something happened in the future. They complained or we tried to collect and they said, I'm leaving town. I can't get a hold of them. They're gone and we can't collect from them. Therefore, I want to reverse it, but I don't want to reverse it to sales because I want to show the sales going up and reverse it as a bad debt that we couldn't, in essence, collect on for whatever reason. And so I can see the bad debt component related to it, which could be especially important if the sale happened last year and we reversed it this year. I don't want to reverse it out, comparing it or contrasting it to the current year's sales. I want to show that this is a bad debt kind of thing. Also note that you might have a situation where you have allowance for doubtful accounts and you got that whole process going on. Same concept that that the bottom line is this adjustment you don't want to reverse the sales item. And I won't get into that allowance. That's a whole another accrual kind of component. But you can do the same kind of thing using the items in the credit memo, whatever you want to do. So we're using a direct write-off method in any case. So we're going to say then that basically negates the accounts receivable. It goes back down, but it doesn't negate the sale on the income statement, but rather puts another account down here called bad debt expense, recording the difference. The difference between these two then is going to net out to 0 on the income statement. So you get to the same starting and ending point, but instead of doing the weird thing, reversing the sales account, you instead make this other account called bad debt. Again, if it was inventory, you might call it sales returns and allowances, which is kind of like a contra sales account. If you're using the allowance method for bad debt, and that's why we were reversing it, you might have an allowance for doubtful accounts, which you would have to estimate to put that on the books, and then you would reverse that, and that's a whole nother accrual process. But, that's the idea. So then bad debt expense down here, we had it going from 0 up by 2,000 to 2,000. The accounts receivable started at 2,000. It went up by the 1,006 to the 3,006, then back down because we issued a credit memo from 1,006 back down to 2,000. Then we issued another invoice for 2,000, bringing it to 4,000, and then another credit memo for 2,000, bringing it back down to 2,000. The accounts receivable subledger, we got inventory 1 was at 2,000. Going up to 2,000 to 3,000, it was at 1,000 to 3,000, minus the credit of the 2,000, bringing it back down to the 1,000, adding the 4 customers up, takes us to 2,000. That matches what's on the general ledger. So that's going to be the general concept. So if you thought about the flow of the transactions as we enter them into the system, when you enter the data into, say, a credit memo or the invoice, it would be recording these transactions. And note, we haven't dealt with inventory. We'll look at the inventory and add that component in a following presentation. But you'd have, in essence, these transactions, and then you would think about them being posted. This is what QuickBooks does on its own, in essence, to the general ledger, which we often see as the transaction detail report by account. And then we use that, and note when they do post it here, because of the data input that we used, which include the invoice and the credit memo, which forces us to add a customer, QuickBooks is also able to generate the subledger due to that added information as well. For example, in this case, related to the accounts receivable. That GL then is used to create the trial balance, which we also broke out here so you could see these few transactions and the impact from the beginning to the ending balance. The trial balance would then be used to create the ending result, which would then be the financial statements, balance sheet, income statement, statement of equity. What we typically do is enter the sales and the sales receipt or the invoices and then the credit memos, jump to the end result, which QuickBooks has then generated, that being the financials, balance sheet, income statement, or P&L, and then think about how you can go here and drill back down. So for example, once you're here, you might say, now I want to drill back down on, say, the accounts receivable. If you were to double click on it, then that would take you back to, in essence, a GL type of report, the transaction by date report or something like that in QuickBooks, which would look something like this, breaking out this information by date. You might then say, I would like to see it not simply by date, but by customer, so I can zero in on a particular customer, which would be something similar to a subsidiary ledger, which would be a report in QuickBooks, a report called the accounts receivable aging, accounts receivable summary, or accounts receivable details, something like that, which you can then zero in on the activity that's more specific to a particular customer, and the total of this subledger then, or that report, should match up to what's on the balance sheet, what's on the trial balance, what's on the general ledger.